What if the portfolio you were taught to trust is quietly betraying you? Now, what if the ballast that was supposed to protect you has become the anchor dragging you down? And what if the most dismissed asset class of this cycle is actually defining trade of this decade? Welcome to the Markets and Leaders podcast. I'm Lyndsay Malchuk. Today we are pulling apart the foundation of modern portfolio construction and asking a very uncomfortable question. Does the old playbook still work in a world of structural debt, fiscal dominance, geopolitical fragmentation, and inflation volatility? And sitting down with me is one of the most respected macro thinkers in the hard asset space, Ronald-Peter Stoeferle, managing partner and fund manager at Incrementum AG. He has published the global recognized In Gold We Trust report annually since 2007 and has become a leading voice on gold cycles, monetary history, and macro regime shifts. His 2026 thesis is bold: the big long, under-owned, underestimated, unfinished. Welcome to the show. This is so great. I'm so excited that you're here.
Thanks for having me, Lyndsay.
You know, I tried to read through the entire report and I was like, wow, this is even far beyond me. So I'm so excited that you're going to be here just to simplify all of it for us. How's the new year been? We're almost quarter one done. How's the new year been for you?
Good. Busy.
Yeah.
Busy, obviously. I mean, it's been a really good start for gold and silver.
Yeah.
Crazy couple of weeks. No, it's been good, and we're already working on the next report. Will be the 20th anniversary of In Gold We Trust, actually.
20th.
Yeah.
I say for the 20th anniversary, the cover has to be pure gold. I'm just saying, just saying, right? Yeah. And then it becomes not just a read, but an investment too.
It's a good idea.
I think I'm onto something, just saying that.
You're going to sponsor it?
Yes, 100%. I'm in, 100%. Okay. I want to dive in here because there is a lot of things that I do want to cover, okay? Now, you opened this year's thesis with a statement that was, we're going to say, a bit controversial, okay? The old playbook broke. Before we even talk about gold or commodities, I just want to hold a moment for this space right now. When you say the old playbook broke, Ronnie, what broke?
Well, the view in the Western world that inflation is not a concern for portfolio construction.
Right.
And that's basically the reason why the 60-40 portfolio doesn't work anymore. So 60% equities, 40% bonds.
Yeah.
And the assumption has always been that, if equities face a hard time, they're struggling, then actually bonds are basically the insurance policy of your portfolio. That used to work for almost 4 decades. But since 2022, it doesn't work anymore. And this is why we came out with the so-called New Gold Playbook, where we said you have to have a slightly different standard allocation for your portfolio. Right. So the old 60-40 doesn't work anymore. So therefore, we created the new 60-40 portfolio. And actually, it really works out. It performs tremendously well compared to the old version in real time.
Well, we're going to definitely unpack that a little bit more, a little bit down the road. I want to stay here for a second. For decades, investors really relied on a simple assumption. And that assumption is when stocks fall, bonds rise. Now, as you mentioned, 2022, that entire thing shifted. And now we see stocks and bonds, they're moving together simultaneously. That correlation completely flipped the script, 100%. Stocks and bonds, that whole thing now, it's changed the absolute foundation of portfolio construction. So what changed here structurally?
Well, it was inflation, obviously. Inflation in 2022 came back, and obviously, a couple of reasons for that. There was the Ukraine war, but then of course also the lagging effect of all those COVID stimulus measures, where whatever it takes, not only rates were lowered, but also there was an enormous amount of fiscal stimulus.
Yes.
And we said already in 2020, well, inflation is around the corner. Nobody really believed us, and it was like a little bit in this story, The Boy Who Cried Wolf, where, after the third time, nobody believed the boy who said, well, actually, there's a wolf attack. So inflation happened. And I think since then, I would say that this inflation psychology has completely flipped. Right. So we're getting used to, ridiculous prices for whatever, for food, for, traveling, for
everything,
for real estate, for you name it. And I think that's this kind of inflation psychology is something that we're pretty used in emerging markets, but we haven't seen that in the Western world. So we had this great moderation where inflation rates came down since the 1980s, interest rates came down, bond yields came down, so bond prices went up. And that was the reason why this 60-40 portfolio worked so well, because people couldn't care less about inflation. Right. Now, I can tell you, Lyndsay, I've been doing keynotes in 35, 40 different countries. Yeah. And the best questions about gold are asked in countries like Turkey, for example. So I did a keynote there in Istanbul a couple of years ago, and I was really, they asked the smartest questions ever.
What?
They knew everything about gold. Why? Because for them, if you construct a portfolio in a high inflation country like Turkey, inflation is like having a proper view on inflation, if it's going to go higher or lower. That's the first question that you ask yourself. So for them, it's just natural to hold gold, to hold hard assets. While we in the Western world, we're not used to that.
No.
We're not used to higher inflation. We're not used to inflation volatility. And I think this is now really changing. And that's also one of the main reasons why I'm still pretty bullish on gold, because I think from this, if there's a big pie of investment allocations, by far the largest pie is fixed income. That's 160 trillion. Right. And if there's from this big pie, even small pieces move to the gold, to the silver, to the commodity space, that's going to have a big impact on those on a relative basis, pretty small pies.
Yeah. Well, I mean, you touched a little bit on the 60-40 split. So historically, that classic 60-40 portfolio has experienced lost decades since, the 1900s, right? Are we entering another one right now, you think?
Yeah. I mean, it actually started in 2022.
Okay.
So now it's 26, say still pretty early. And based on this graph, it usually, it's on average, it's a decade. Okay. Where this 60-40 portfolio doesn't work anymore. So one of our main assumptions is that we're in a structural bear market for bonds. Right. And I think that you've got some, closet gold bugs in institutional asset management. So a couple of really big guys that I'm talking to, they actually know that you will have guaranteed losses, especially on an inflation-adjusted basis with those fixed income allocations. But they've got their mandates. So I would say that it won't be like in the 1970s where we've had bond funds actually holding up to 40% physical gold. It's not going to play out like that because of financial repression. But just one number that came out by Bank of America yesterday. So they are forecasting for the US to have, on average, yearly deficits of 2.4 trillion every year in the next 10 years.
Whoa.
And that's under pretty, I would say, optimistic assumption. And the assumption is that the US won't face any recession over the next 10 years. So if there's a recession, it's going to be even higher.
Right.
So, that's big numbers, I would say.
It's a mass. Those are
and who's going to buy all those bonds?
And that's the thing, is we were talking about this today, buying the deficit amount. I mean, that's another big undertaking. Do you think the foundation is set up to be able to handle that, to be able to navigate through that much deficit?
Well, I think when, what hits the fan, then politicians become really creative.
Yeah.
So for the US, for example, I'm not sure if Donald Trump is the smartest guy on earth, but I think he's got good people in his team. Let's put it that way. And I think as a real estate developer, he knows the importance of interest rates, and he understands debt servicing,
Right.
So they kind of know that many other countries are not too optimistic about holding and buying more U.S. Treasuries anymore. So there's a couple of European asset allocators who actually said, well, we're getting rid of our U.S. Treasuries. Then obviously China isn't buying any U.S. Treasuries anymore. So who's gonna
do it?
Who's gonna do it? And I think with the Genius Act, they identified like stable coins becoming like a new buyer. So Tether and other stable coins might pick up some of them. But I think that, and that's really, I would have said like 2 years ago it's never gonna happen.
Right.
But Dr. Judy Shelton, we interviewed her previously, and we will interview her for the upcoming In Gold We Trust report. So she is recommending gold-backed bonds, actually
Really?
50-year or even 100-year treasury bonds backed by gold,
Right.
20-30%, whatever. And I think that's a pretty interesting idea. And Judy Shelton is pretty close to Donald Trump, actually.
Right.
So, let's make a thought experiment. What if, you've got the 250th birthday of the United States on 4th of July, 2026. What if they come out with, let's say, 20% gold-backed century bonds? And then they say, well, if you're a pension fund, if you're an insurance company, if you're perhaps a European country that still wants to be protected by the US military, you actually have to buy those bonds.
Yeah. They pinholed it.
Exactly. So, those Donald Trump is always talking about this sticks and carrots policy, and I think that would fit into that quite well. So I wouldn't rule that out. And if you put like a 2 or 3% yield on that with some gold backing, and then say, well, institutional players actually have to buy it, otherwise something's going to happen. Yeah. That could be some sort of a solution.
Well, you've actually proposed a different kind of framework then for the 60-40. We're going to go back to that. A new 60-40, less bonds, more gold, more silver, commodities, even Bitcoin.
Yeah.
That's not just a little tweak. I mean, that's a philosophical shift there. Is this, how do I put this? Is this just about diversification, we'll say, or is this preparing for something like deeper, like a deeper monetary or fiscal reset or something like that?
Well, actually, we crunched the numbers and just analyzed what works in a time of higher inflation or higher inflation volatility. And commodities are a brilliant inflation hedge. Obviously, mining stocks should do pretty well. Then we differentiate between what we call safe haven gold, which is physical gold stored in safe jurisdictions, perhaps outside of the banking industry.
Smart.
And then what we call performance gold, which is mining stocks primarily, but they're not really, in the industry for quite a while. Mining stocks are in the buy and hold. There's just very few high quality miners out there.
Yeah.
So you really have to, position yourself in the mining space very actively. They're like big drawdowns, 60, 70, 80%. It's not like daily business, but it can happen.
Well, we hear it often. It's like, we believe we have the next big blah, 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 right?
Yeah. Generational opportunity.
All the things. Yeah. Check.
So, but it is, and that's really important to understand. So we also crunched numbers on that in the second half of a secular bull market for gold, and those bull markets usually last for like a decade. What you want to be overweight in the second half of a secular gold bull market is actually silver, mining stocks, and commodities.
Right.
So we're now, gold always goes first, yeah. But then at some point, like in cycling, there's a breakout coming. And I think we saw that big time last year. And that was the main thesis of last year's In Gold We Trust report, the big long. We said, now is the time to be overweight silver mining stocks, and commodities.
Okay.
So the new 60-40 portfolio is basically a portfolio recommendation for a time of higher inflation volatility, structurally higher inflation rates, and they're already discussing, raising the inflation targets from 2 to 3%. Just for a short time,
Right.
obviously. So I think that the portfolio should work really well in such an environment. But I think the big question for us is this just a normal cycle,
Right.
or is it a remonetization cycle?
Okay.
And I would say, with people like Scott Bessent saying that he wanted to be a part of a Bretton Woods moment. Recently, he said that he was asked if he follows gold, and he said, well, actually, they are very happy about the gold price development. Right. Then there's people like Stephen Miran writing a brilliant paper, basically the playbook for what's going to happen, where they also write about the revaluation of gold. So I think gold is really, we're now in this remonetization cycle.
Right.
And every couple of decades, and I always want to be optimistic and positive, but if you read monetary history, every couple of decades, there's just, a remonetization of gold happening, which obviously goes hand in hand with let's say, a shift in the global reserve currency and just the way that the world deals with each other.
Right.
So I think that's really the big question. And if we're really talking about the remonetization of gold, then 5,000 is still pretty cheap.
Pretty cheap. Where do you think Bitcoin fits into that new 60-40?
Well, people hated us. Not hate, but there was some criticism. Yeah. When actually my partner Mark and I, we bought our first Bitcoins very early on, 2011. And we just thought it's interesting. It's like a new monetary technology. And we're very much, we're not only from Austria, but we also adhere to the Austrian School of Economics. So sound money is really important for us. And we said, gold obviously is sound money with a track record of 5,000 years. Now there's Bitcoin, and Bitcoin actually, Satoshi Nakamoto, whoever it was or is, he clearly understood gold, and he understood the flaws of our monetary system. So the stock to flow ratio for him was really crucial. And actually now Bitcoin has a higher stock to flow ratio than gold. So it has a lower inflation rate than gold, and it halves every 4 years. So we said back then already, let's do a fund combining gold and Bitcoin. And back then it wasn't easy because, financial market,
they push back.
The authorities, also the banks and the fund administrators, they didn't know where to put it. Is Bitcoin is it a currency? Is it a normal asset? Is it an alternative asset? Is it a commodity? What is it? Where should we put it? So what we really did, and being a first mover always sounds like super, super interesting, but it also means lots of work, because
stress.
You have to educate people and say, well, actually, let's do a workshop and we'll work through all your questions. So then actually 6 years ago, we launched, I think, the very first investment fund that combines gold and Bitcoin. Strategic allocation is 75% physical gold, 25% Bitcoin, with the rebalancing. So every time Bitcoin goes to 40% allocation, we're selling it down to 25%, or vice versa. If gold has, if the allocation in gold is too big, we're selling gold and we're buying Bitcoin. So it's
fascinating.
we use options to rebalance, to actually harvest the volatility of Bitcoin.
Right.
Now, I know that especially in the gold camp, there's many people that actually hate Bitcoin. I know
course.
many people in the Bitcoin industry that hate gold. At the moment, not so much. I think there's many people from the Bitcoin camp coming to the gold camp. But we are all in the sound money camp, yeah? And obviously, Bitcoin is much riskier because it's still a teenager and it's still kind of wild and volatile, and it doesn't have this 5,000-year track record.
Right.
But I think it achieved quite a lot within a very short time frame. So
Absolutely.
we've got in our new 60-40 portfolio, we say 5% Bitcoin.
So the thing is that what they don't both really grasp yet is that they almost need each other. Bitcoin needs the gold for mining. Mining needs the Bitcoin for, whatever it is, whatever they're going to do for their mining as well. So it's an interesting take on how they're kind of rivalries without being rivalries.
Yeah, I mean, I think it's no coincidence that the logo of Bitcoin is a gold coin.
Right.
That you're mining Bitcoin actually. I already mentioned the stock to flow ratio, which is really crucial. So I think there's many similarities. There's some differences, and I always make the comparison. People ask me, gold or Bitcoin? I say, you can have your Ducati motorcycle and your large SUV like a Land Rover or whatever. You can have both, yeah. And on the Ducati, it's obviously more fun.
It's a Ducati. Let's be honest.
But if it's, if it starts raining or snowing or if it's icy, you rather want to be probably in your Land Rover.
100%. Yeah.
But still, you can have both, yeah. And therefore, our view has always been, this is like sound money, hard assets versus the fiat world. And therefore, the demographics of the gold world and the Bitcoin world is pretty different, yeah. While at the gold conferences, I'm still one of the younger ones there. You're seeing lots of gray hair. I mean, I'm losing my hair, but still,
not gray.
For 20 years, I'm still one of the younger ones at those gold events, and at the Bitcoin conferences, I'm always like one of the oldest ones.
That's true.
Yeah.
So it was Joe Brunner on, and we were talking about how Bitcoin is actually bringing in quite a younger audience, and they're learning that it's not just Bitcoin that they can look at.
Yeah.
I can't really maybe afford to buy the Bitcoin, but what makes the Bitcoin? Let's delve into that a little bit deeper. And there's other little aspects that is carrying them over to commodities or to currencies or whatever it is. And really, there's so much education that's still needed, but that younger audience is now becoming a little bit more intrigued about learning about it, which is really great to see.
Yeah.
Absolutely. So pulling this back, because we completely digressed, which I love, if this reset that you speak about, if it goes underway, it brings us to positioning them. Because if this is a structural bull market that you speak of in hard assets, ownership tells a very fascinating story. Gold ETFs represent, just 0.17% of U.S. policies. That doesn't look like excess. That actually looks like a bubble to me. Is that what it looks like to you?
No, it's an anti-bubble actually. Yeah.
Okay, explain that.
So 17 basis points. That's even lower. I think that's 5 basis points lower than in 2012.
Okay.
So we crunched the numbers, and there's lots of reports out there regarding the institutional ownership of gold.
Okay.
And it's so small. So Goldman says 0.17%, so 17 basis points from their institutional clients own gold ETFs.
Right.
Then there was the UBS Family Office survey, where they had 2% in gold and precious metals and less than 1% in commodities.
Yeah.
And then quite recently, there was a JP Morgan report where they questioned, I think, family offices owning more than $3 trillion US. And 70% of those family offices don't own any gold.
Zero gold
and
assets.
The average allocation is 0.9%.
Wow.
So my view is that if we take a step back, what's the long-term drivers of this gold bull market? I think it's people in the Western world, they tend to forget that this bull market is primarily being driven by emerging markets demand.
Okay.
And if you go to Turkey, I was in Saudi Arabia last January. If you go to Vietnam, if you go to India, obviously, to China, you can see, you can feel, you can smell, first of all, that everything is kind of buzzing and, there's just much more activity.
Right.
That everybody is optimistic. Everybody thinks, okay, if you work hard, you will achieve something. Talked to a guy from India, and he just explained how their life changed compared to, the generation of his parents. It's like completely different. Wow. Yeah, now they can afford to travel to Europe.
So great.
And I think people in the Western world, they don't understand how important gold is actually in those countries. So nowadays, like more than 2/3 of the gold demand, of the physical gold demand, is just coming from China, India, and the Arabic world. So the center of the gold demand or the gold world is actually, it's not in the Western world anymore. Yeah, it's in emerging markets. I think that's the foundation of the bull market. And there's a very strong correlation between prosperity in emerging markets and actually gold demand.
Right.
So, if the economy is doing well in those countries, they buy more gold. It's pretty easy.
Yeah.
Then the second stage of this bull market was obviously 2022 with the invasion of Russia in Ukraine, and then the sanctions, where the Western world basically said, Russia, your 350 billion, they're now worthless. Yeah. You can write it off. That was obviously the reason why other central banks said, well, actually, if they can do it with Russia, they can also probably do it with us.
Yeah.
So if you travel to a foreign country and you only have like one credit card and the credit card doesn't work anymore, well, you want to have a plan B. And I think that gold is like this plan B for those also mostly emerging market central banks. So China has been buying big time. Obviously, Russia also bought lots of gold. Then you've got Vietnam, but in Europe, you've got Poland, for example.
Really?
You've got the Czech Republic, you've got Hungary buying gold.
They're all sort of starting to hoard it.
Yes. So 3 years in a row of more than 1,000 tons of gold being purchased. Last year, 2025, was 863 tons. Which is a little bit less, but in absolute terms, because the gold price has risen so much, it's an all-time high in terms of central bank demand.
Right.
Now, can it continue? Yes, I think so. And even if it's just 700 or 800 tons, we'll see. But the allocation of emerging market central banks to gold is significantly lower compared to the Western world.
Okay.
So that was the second part of this bull market. And now only very lately, it started in 2024 a little bit, but in 2025, it really got going, is Western financial investors. Now, a little bit Johnny-come-latelys, but now they started buying gold ETFs, buying mining stocks. So they only started, they only entered this bull market very, very recently.
Mm-hmm. That's true. Well, commodities, I'm going to flip over to commodities now. They're still very under-owned. Energy makes up of, 2.8% of the S&P 500. And sentiment remains still very bearish in that industry. So when you see that combination of rising prices and lower ownership, is that, typical late cycle behavior or early cycle opportunity?
I think it's early cycle opportunity.
Tell me why.
Well, 2.8% of the S&P 500. I think it used to be 16% for energy stocks in the previous bull market. For commodities in general, I would say the allocation, if you have a look at, for example, commodity ETFs as a percentage of all ETFs, I think it's like 2.8% or 2.7% at the moment. But if you take out precious metals, it's performed by far the best. Well, actually, it's still flat. Yeah, we haven't seen any bigger move yet.
Right.
And our take has always been gold goes first, then silver and the mining stocks follow, and then at the very end of this cycle, of the gold cycle, is actually commodities picking up momentum. And this is what we're seeing now. So we're seeing it in the copper space. We're seeing it.
I was just going to ask, where does copper fit into that?
We're seeing it in rare earth, obviously. We're seeing it in uranium. We're seeing agricultural commodities, not so much yet. But I think, and there's like 3 points that I would like to make when it comes to commodities. First of all, positioning. The big trend in institutional asset management over the last couple of years was ESG.
Okay.
And I think that's, in Europe, it's a little bit different. While the US, they couldn't care less about ESG anymore. I don't know what it is in Canada. I think probably more.
Okay.
But in Europe, you know, if I went to a big investment conference, it felt like Greenpeace convention.
Really?
Yeah, it was really like everybody was so green and so sustainable and so good.
Here we go.
But I know that it was a little bit shallow, and everything that had to do with mining and commodities was bad. Those people never, they never made a mine visit. They just said mining is bad, it's dirty.
Yeah, very true.
Which is also, I think it's that's actually something that we should correct, and we should improve the perception of mining.
That's the thing.
Outside of our bubble.
Right? So there's
Really
a lot
important.
of companies now who are developing these technologies that make it so much more. There's a company called Resolve, RZ, Resolve.
I'm invested there.
Yeah, right? So they're making these massive moves and not using those harsh chemicals to be able to pull the gold out. So there's a lot of education still that's very much needed around mining, how it traditionally used to be, on how technology is bringing it into the modern world. And I think that's where the fall point is there's needs to be way more education around this, so that perception is cut.
Yeah, and it's also about employer branding. We invested in a company called Mining Visuals, and they are doing some employer branding because actually, all those super smart graduates, where do you want to work? At Google, Facebook,
So true.
AI companies. Nobody wants to work for BHP Billiton, Rio Tinto.
I know.
Whatever, But I think it's really important to make a positive case, and just, show what the companies are actually doing for their communities.
Yes.
And this is why we're writing about that in the Gold We Trust report for many years now. However, that ESG trend, that also meant basically that, if you're an institutional investors, you didn't want to have any allocation in, commodities, especially in oil, gas, but also copper, agricultural commodities. You just sold everything. Now this is kind of changing because I think also politicians realize that you need safe and secure and reliable access to commodities because everything here, it's made out of commodities.
100%.
And if you can't grow it, you have to mine it. So I think it's a process, but I think this perception of commodities is changing in asset management. Then we're obviously seeing that those cycles are really long cycles. So the cure for high prices are high prices, and the cure for low prices are low prices. So we're seeing this massive amount of underinvestment over the previous cycle. And now, there's an enormous amount of copper demand, of silver demand, whatever. But there's just no supply, actually, And also, if you look at the development projects, there's nothing really big coming on stream over the next couple of years. So that's the second thing. And then I think the third reason for commodities is actually that now everybody still believes in disinflation, and most people are ruling out that a next wave of inflation might be happening. But I think at some point people will realize, well, some inflation protection totally makes sense. And as I've said before, commodities are a brilliant inflation hedge.
Right.
So I would say the risk reward for commodities is even better than the risk reward for gold at the moment.
I want to stay with the S&P 500 because we have seen gold outperform the S&P 500 for 6 straight months. That's phenomenal to see. the longest streak since I think it was the global financial crisis. Historically, what does that mean globally?
Well, there
What
was
is
a
this signal?
great great table by Subu Trade on Twitter, and he actually crunched the numbers, and he said if you've got 6 months in a row of gold outperforming the S&P 500, then 9 and 12 months ahead, it has always been a positive performance for gold.
Okay.
Now, that's just statistics, but I think it's really good work. However, I think what's more important is this relative valuation of gold versus the S&P 500.
Okay.
So if you have a look at the gold S&P ratio, I think that we're now seeing relative strength of gold versus equities, but I think this has only started. Now, how can it resolve? Obviously, gold being flat and the S&P 500 collapsing, I think that's not what Donald Trump actually wants to see, especially with midterm elections. Then we could see, gold and the S&P rising, and gold just massively outperforming the S&P. Yeah, perhaps. We could actually see the S&P 500 basically flat and gold continuing to rise. So there's a couple of ways how it could resolve. But I think what's really important, Lyndsay, is, gold is expensive versus oil, versus lots of other commodities. It is not expensive relative to equities. And I think if we have this monetary framework, then I think gold is still pretty cheap compared to the amount of money that was actually created over the last couple of years. The new amounts of debt coming up, just last year, first half of last year, new debt, 21 trillion. We talked about US deficits. Bank of America says 2.4 trillion every year over the next 10 years. So if you have those numbers in mind, I think gold is it's not dirt cheap, but it's not super expensive yet.
It's substantial enough.
So my take is we're in a bull market. We're not in a bubble yet. Okay. We haven't really seen, mining stocks only recently started outperforming gold, but we haven't really seen junior mining stocks outperforming the large caps yet.
That's it. Yeah.
That's what we usually see at the later stages of the trend. So if you have that monetary framework, if you've got this view, then if the US monetary base would be backed 100% by gold, the price of gold would have to be $21,000. Now that sounds like crazy, but we actually had that in 1980 and in the 1930s.
Really?
So, would I rule out that those price targets can be achieved? No, I cannot rule it out, especially if we really should be in a, let's say, a reorganization of our monetary system. Then obviously gold will play a major role, like every time.
Absolutely. So you have also presented your shadow gold price model. If gold were to back monetary base again, we're going to go there, equilibrium levels would look dramatically different. Is that a thought experiment, or is it a serious framework for thinking about long-term currency debasement?
Yeah, it's a framework that actually gives you this monetary valuation point of view.
Right.
And we once had an interview with he's very secretive Fofo, a friend of another. It's really like
feels like telephone. The game telephone.
It's like he's a great blogger, and I really read everything that he puts out. And we had actually 2 interviews with him, and he said, you only need one gold revaluation in your lifetime.
Okay.
If you play that well, that's actually enough. Now, you being from Canada and probably many listeners from the US, that's a different view. While, being from Austria, talking to my grandparents, they lived through 5 different currencies.
Wow.
And for them, and I think that's kind of in our monetary DNA, I always got little gold coins from my grandparents.
Cool. Did you keep them? Ish.
Kind of, yeah, because if you're young, you're like just selling and buying stuff and, partying or buy a bicycle or I don't know what I bought. But I think it was like, if you really get like a physical coin for like the bigger events, and if you touch it and if you build up some sort of a relationship,
Right.
and every time I give somebody gold, and people look at it and everybody, it puts a smile on your face. Yeah, it's something magical. And I think that through those experiences with hyperinflations and currency reforms in Germany and in Austria, obviously, I think the view on those things like changing currency regimes, that's a different one in Europe compared to North America. Again, if you talk to people in Turkey, in China, they also had their hyperinflation. Yeah, people in India, of course, for them it's just normal. Gold is money. Yeah, I mean, it's just
is.
There's no discussion.
Yeah,
and I think that therefore, with all the problems that we're seeing, but then also with Donald Trump, first words at his speech was, "Welcome to the golden age." I don't know, perhaps it's a coincidence. But then you also have, like I mentioned, Scott Bessent, Stephen Miram.
Yeah.
You've got Howard Lutnick,
yeah,
who clearly understands gold. So I think those guys in the administration, they're pretty open about that because they want to defend the status of the US dollar being the world reserve currency. But then on the other hand, they also want to weaken the US dollar.
Why?
For this, renaissance of US manufacturing. The US dollar is just way too expensive.
Right.
Compared to the euro, but also especially compared to the Japanese yen, to the renminbi. I think that's going to be one of the most important developments this year if the renminbi really continues to rise against the dollar.
Yeah.
So actually, the US wants to have both, defending the US dollar as the world reserve currency and then also weaking it.
Two sides, same coin.
Not sure if it's going to play out that well.
I don't know either.
But I think that with this view that actually it's about the world reserve currency and that it's being questioned, this whole de-dollarization, we always said it's not one point, it's not one reset, but it's a process, and it's a long process. Yeah? And if you have a look at like all those bilateral agreements and the Chinese coming up now with a really good competitor to the SWIFT system, and Chinese are invoicing like more than 50% now in renminbi and not in US dollar terms anymore. So there's, this development is definitely picking up momentum. But, if the US doesn't run the world reserve currency anymore, they cannot have this, what the French once called deficit without tears.
Okay.
So I think this is really the and sometimes I wake up and say like, all these things that we're writing about for almost 20 years is now really happening. It's happening. Yeah.
It's already here. It's already happening.
So it's going to be really, really interesting the next couple of months.
Absolutely. Now, naturally, once investors, they understand the core, they start to look for torque then, which brings us then to silver. You call silver convexity on gold. For investors watching who may not fully understand that term, what makes silver so explosive when gold moves forward?
Well, gold is like the kind of the old guy sitting there pretty relaxed, perhaps having a glass of whiskey.
Definitely.
Just seeing things happening.
In his leather chair.
Exactly.
Many leather-bound books.
Exactly. Listening to some Beethoven. Yeah.
That's exactly
And then you've got
it.
silver.
Okay, silver.
Silver is like the crazy cousin.
That's it.
It's like
comes in with his sunglasses,
going wild. Yeah, just partying like crazy.
Absolutely.
And a little bit more. How do you say? What's the right term? Flamboyant or
liberal.
No, What?
Liberal.
Liberal. Yeah, that's
Liberal.
Yeah. No, but silver is volatile. Silver is a much smaller market than gold, obviously. But silver, once it really starts outperforming gold, it's just going. And we saw that like last couple of weeks, when silver went to 117, and then we've had like, I remember it was Friday, and I was skiing actually on that day, and silver was down 30%, and we kind of expected that, but then still 30% drawdown in one day, that's like
a lot.
It's historic.
Yeah.
So I think for gold around the 5,000, but also silver around 75 to 80, that's like we're building a base now.
Right.
And I think that for silver, I just had a great meeting with Keith Newmer at First Majestic, and he's in the silver space for ages, and he's been educating people about the virtues of silver, and we had a really, really great conversation. And the fact that now finally investor demand is kicking into this, it's coming into this fairly small silver market,
right,
where many people say, well, actually gold is already too pricey for me, but on an absolute basis, actually silver is pretty cheap, inflation adjusted. On a relative basis compared to gold, well, gold-silver ratio still, at average levels basically. And I really need a little bit more, momentum.
Right.
And I think that for the silver market, if there's really more and more generalists coming in, more and more investment demand, if that meets like this structural growth from the industrial side, photovoltaics, but then also, obviously the military. So for defense, you need like lots of silver.
Yep.
But then also, for all sorts of appliances where you see, okay, this industrial demand is just growing and growing. And if there's just a little bit of investment demand kicking in, that really moves the market. And we saw that recently. And I think that's now people think that between 70 and 75, that's a really good buy. So I think that's going to be the base camp for the next cycle in silver. So we're pretty optimistic when it comes to silver, obviously. And we crunch the numbers, and again, second half of the gold bull market, you want to be overweight mining stocks, silver, and commodities.
Well, then let's flip over then to that risk curve to leverage. Large cap miners, like you said, they are really beginning to outperform gold. And as you said, the junior miners, they're still sort of being muted, we'll say. Would you say that this is typical early cycle behavior?
Yes, I think it's normally what you want to see at the very end of a gold bull market. And we're actually having a chapter, basically like a checklist,
Right.
Just analyzing, what you usually see at the end of a big bull market. And you usually, you would like to see mining stocks outperforming gold. Okay. Obviously, yes, we're having that. But at the very end, you're seeing the junior space outperforming the large caps big time. And we haven't really seen that yet.
Not yet, no.
So I would say, like, if we're, let's make the analogy. If you go to a cocktail party,
right?
I don't really go to. I don't know.
No, you don't.
No, I'm not really in. I don't know. Not invited, or just
I highly doubt that.
Just
networking
working
events.
Too much. But I don't enjoy it too much anymore.
Fair enough. Yeah.
But let's say, okay, cocktail event for like people outside of our little gold and silver bubble.
Right.
Like a couple of years ago, if I would said, people would have asked me, you're in the asset management industry, what do you like? And I say, I like gold. I would say, gold. Yeah. I mean, that's,
Come on. Think outside the box.
It's boring. It's just going down, and it doesn't pay any interest.
That's
and
right.
Why not own Nvidia and
tech?
Tech, yeah. I say, yeah, okay. So if I go to the cocktail party now, people say, "Yeah, gold." I always knew, Ronnie. Yeah, gold is. I always
Of course
said
you did.
you gotta own some gold.
Absolutely. Sure. Now you're the favorite in the room.
And people would say, "Well, what about mining stocks? Yeah, do you like Barrick, Newmont, Agnico?" And I say, "Yeah." So they're kind of getting interested.
Yeah.
But I think in 3 years, if we go back to that cocktail party, people will say, "Ronnie, what's your favorite silver junior mining company?
Yeah.
Can you get me into some private placements? Private companies, perhaps in the junior exploration camp in, I don't know, in Congo or
Desert Gold,
whatever,
Copernico, Eminent, like all the things, Lorien,
But we're not there yet, yeah. So I think the risk appetite, yeah, it's changing. Of course, it's a function of the cycle, but we'll get there at some point, yeah. But we're not in this crazy phase yet. And I just had a look at the quarterly numbers, and Agnico came out with, like, if you just have a look at their free cash flow and their net profit, and their cash costs are like $1,000 to mine 1 ounce of gold. Their all-in sustaining cash costs, I think, $1,600. I mean, it is ridiculous how much money those companies actually make. And the good thing is, we're not in this crazy M&A cycle yet. So I think that their management teams, they learned their lesson from the previous bull market, but especially from the bear market, where at the top of the bull market, we saw like ridiculous M&A activities, yeah. Will they make the same mistakes again in this cycle? Probably yes, but then that's actually our job to to analyze which management teams won't make those mistakes.
On my end, sitting in this chair, my gosh, am I ever seeing an excel in M&As across Africa? I mean, I just came back from South Africa, and wow, it is, first of all, what a resource-rich country and so underdeveloped. But the M&As coming out, you start seeing more and more, not just in Africa, but just across the board, more and more and more and more. And I wonder, is that a good thing? Is that signaling something better and bigger and something that we don't know about? Give us the insights here, Ronnie.
Well, I think what really changed is the fact that, and that's not so much in gold, but definitely in the critical minerals, or however you want to name it, yeah. Especially in copper, we're seeing that. That's what many companies tell me. Well, actually, there's like government representatives knocking on our doors saying,
Let's go.
You need financing. Let's do an offtake agreement, stuff like that. Gallium, for example, yeah, very good example. So there's like, lots of interest coming from governments, actually, because they realized, well, we need safe and reliable access to commodities.
Do you think that's a power move then?
What do you mean by power move?
They want that easier access, which then ups their ante with their power. Like at any point in time now, they can take whatever they're investing heavily into these companies now. Does that give them then more power to that access because they become heavy investors in these projects?
Yeah, I mean, I think it's the realization actually that China is doing that for many years already.
Yeah.
Building infrastructure, ports, roads, refining capacities, and so on. The Chinese are, always playing the long game, and then they're doing it for many, many years. And I was at this Future of Minerals conference in Saudi Arabia last year, and I'll go back next year again because it's really interesting. It's a completely different crowd. You're seeing so many Chinese companies there, yeah.
Okay.
And they're so active in Africa. I was in Ethiopia a couple of years ago, and if you're on a plane, it's full of Chinese businessmen, yeah. So I think it's the Western world, the US now, pretty late realizing, well, actually, we have to compete and we have to get that access. Now, I was on the plane flying from Frankfurt to Vancouver, and there was a German scientist sitting next to me, and a super interesting guy. Yeah, we talked about about hydrogen, about green hydrogen, and he actually said that because everybody is so pessimistic when it comes to Europe, and we Europeans, we tend to see the glass half empty, while the Americans always see it half full. Yeah. So, but then I think the truth is somewhere in the middle.
Totally.
And actually, European equities started outperforming U.S. equities a couple of weeks ago, big time, and the relative valuations are just, it's just staggering how cheap actually Europe is compared to the U.S. anymore. So one of our take is actually that the U.S. has been a destination for capital for 15 years.
Yeah.
And I think this is kind of reversing with all the Trump policies and so on. So it might become, the source of capital. So if there's really reallocations going out of the US into Europe, into emerging markets, into hard assets, I think that's a very powerful trend. Now, coming back to this gentleman from Germany, he actually said that, well, there's an enormous amount of brilliant scientists in Europe, really, really good people, in universities, for example. So what he and his institute is actually doing, they're going to Australia, and they are coming now to Canada, and they're basically exchanging knowledge and the scientists and the intelligence that they have with resources, and saying, well, actually, you've got the resources, we've got the people, actually, and I think that's a pretty interesting approach that he's. And then on the other hand, the Chinese have a different approach, and the Americans have a very different approach. So I kind of liked what he said, and the interesting thing is, he said, finally, Europeans also realize that commodities aren't a bad thing, but actually, we just need the stuff. So I think this, this political demand for commodities, this is very different compared to previous cycles. And this is, once bureaucrats, start moving, it's usually a longer cycle. So this is really a big trend that we're seeing now.
Okay, let's zoom out here, because this isn't just about metals. This is about macro structure as well. You use the term fiscal dominance. So for viewers who hear that and they think it sounds abstract, I mean, what does fiscal dominance mean in practical terms?
Basically means that the fiscal side is becoming more important than the monetary side.
Okay, unpack that further.
So I think we started with COVID.
Okay.
During the COVID crisis, central bankers did what they always do in times of a crisis. They lowered interest rates, they did quantitative easing, or just monetary stimulus.
Yeah.
But then actually, I think, politicians also realized that monetary policy works with a very big time lag.
Okay.
So if you do QE, you've got an impact on asset prices, but with a time lag. And you don't really have an impact on inflation and the economy. So it mainly stimulates asset price inflation. Now, obviously, COVID was a deflationary shock because everything was, standstill.
Sudden, too.
So what happened back then? Massive fiscal stimulus. It was basically whatever it takes, but now on the fiscal side. And we got all the checks basically from the politicians for sitting at home, watching Netflix, having red wine, way too early.
Happy hour was all day, every day.
So, and then actually politicians realized, well, it actually works, and people, enjoy getting the stimulus checks and so on, and perhaps it helps with the next election. And that was the point in time when actually monetary policy and fiscal policy got much closer.
Right.
And now we're seeing it actually with, this is becoming basically the standard approach, I would say, for politicians. Because, the deficits last year in the US, it was 2.3 trillion. but everybody's kind of getting used to that. So we're in this moment where politicians say nobody cares anymore. Yeah, the Japanese have got much higher debt levels. Yeah,
Right.
So I think that this is like that we also saw with Elon Musk with Doge, where he said we can fix the deficits. Yeah, we can just get rid of so many expenses and just shrink the bureaucracy.
Yeah.
I mean, after a couple of weeks, actually, he said it's not going to happen. Yeah, there's no political will. It's just impossible. So
Wild.
now the U.S. has say, well, we're going to raise our defense budget from 1 trillion to 1.5 trillion. Yeah.
Oh my gosh.
So I think this fiscal dominance is something that is one of the main reasons why we think that inflation will stay around the corner, and actually inflation volatility will become a main driver for portfolio construction. And we're not only seeing it in the US, we're also seeing it in Europe, obviously, where military expenses are becoming a really big driver.
Right.
Then on the other hand, I think politicians can be pretty creative, because in Germany they don't call it debt, they call it Sondervermögen. So it's
I'm sorry. Say that again.
Sondervermögen.
What does this literally
So the money
mean?
that they're spending on the military, that's actually not within the official government statistics.
Okay.
So a Sondervermögen is like it's like a special purpose vehicle, kind of. Yeah.
Sounds like a really creamy, rich food dish.
So saying like we're raising our debt significantly doesn't sound as good as saying we're doing like a Sondervermögen now for those military expenses. So I think that's the new zeitgeist now.
Right.
And this clearly is the main reason why this our one of our key takeaways, that fiscal stimulus and fiscal dominance will be around for the next couple of years.
Wild.
I think this is one of the main reasons also why we think you should be massively overweight, this what we call this new 60-40 portfolio. We've got more allocation to hard assets like gold, commodities, mining equities, and so on.
So do you think policy crossed the point where credibility matters less than managing debt levels then?
Yeah, I think at some point, I don't know how you say it in English, but once your credibility is lost, yeah, you don't care anymore, yeah?
Yeah. Yeah. I mean, I guess it's sort of the same.
Is there any I don't know, somebody from the movies or any musician where I say he doesn't care anymore?
He doesn't matter. We would say it doesn't matter
about his reputation.
anymore. They don't matter. It doesn't matter.
Yeah.
Or, now there's the new one, cancel culture.
Yeah.
Once your credibility's gone, you're canceled.
Yeah.
Okay, so if we are entering a structural dollar bear market, Ronnie, how transformative could that be for commodities today?
Well, commodities usually do pretty well in a dollar bear market.
Right.
And we haven't seen anything yet. So compared to previous big dollar bear markets, 35% up to 50%. And I think, from a valuation point of view, even mainstream economists will say the US dollar is too expensive.
Mm-hmm.
Donald Trump wants and he needs a weaker US dollar. Mm-hmm. Then I think the market participants, people are still pretty confident regarding the US dollar. So we haven't seen any extreme positioning yet in markets.
Okay.
Commitment of traders report, but also sentiment-wise, I think there's still way to go. And I think, if you understand previous cycles, then I think, the US dollar entering like a large bear market, that's one of the best setups, not only for gold, but commodities as well. And I think that more and more people are kind of realizing that. There's I don't know, I think Mike Wilson at Morgan Stanley, great strategist, he just came out with the 60-20-20 portfolio, 60% equities, 20% bonds, 20% gold.
Wow.
I thought Morgan Stanley is
Interesting.
somewhat larger than Incrementum. So I think it's that was interesting. But then you've also got like people like Ray Dalio. You've got Paul Tudor Jones, for example, Stanley Druckenmiller. I think they're all kind of in the hard assets, weak US dollar camp. I think it was Druckenmiller. His largest position in the last quarter was actually he was buying Brazil, which is also a great commodities proxy.
Really?
So I think that's really, we're at the very early innings of a dollar bear market, of a commodities bull market, and I think that gold is already signaling it. So as I've said, gold always goes first, yeah.
Right.
But then with some sort of time lag, it's silver and commodities following, and I think that's what we're seeing now.
What if we talk about inflation? No, pardon me. Why don't we talk about disinflation, actually? You argue that the era of disinflation is over. So given that, should investors prepare for inflation volatility instead of stability then? And we're going to push it a little bit further, actually. Is another round of quantitative easing inevitable, whether policymakers admit it or not?
Well, there is already some sort of quantitative easing. They don't call it QE, but then you've got Kevin Walsh, and I don't think he's a hawk. I think he can be hawkish, but also very, very dovish. So the interpretation by Wall Street was Kevin Walsh is coming in. He's a hawk. Sell gold, sell silver. Okay. I think more people are realizing now that he's pretty flexible. But he said that he wants to see a smaller balance sheet of the Federal Reserve. Yeah. Okay. So I wouldn't expect another round of QE when Kevin Walsh comes into office. However, I think that, as I've said before, it's fiscal stimulus that is becoming much more important. It's some sort of a yield curve control that will be implemented at some point, probably. So basically, putting and we've seen it over history actually during financial repression. Yield curve controls should never be ruled out. I think that's going to happen. And then again, I think that over the next couple of years, probably the 2% inflation. It used to be the ceiling. Now it's probably the floor. And I'm not forecasting like hyperinflation, but just higher swings when it comes to inflation, like we see it in many emerging market countries. And actually, if you have a look at a couple of different indicators like debt levels, but also the direction of inflation, the growth rates compared emerging markets versus developed countries. Emerging markets, versus industrialized countries, well, it's pretty easy that over the next couple of years, you probably want to own emerging market investments. And I can just urge everybody, and this is a part of my job, just travel. Go to other countries, and you will see, everybody, people have got the view if they work hard, if they really put in the numbers and work their asses off, they're going to have a better life for themselves, but also for their kids. While in the Western world, it seems like we just want to protect what we got,
It's because we can't afford anything here.
Yeah.
That's exactly it.
No, but people are pretty pessimistic, I would say.
Right.
I think in the US, it's still this kind of let's do it attitude and just work hard, be entrepreneurial. But in Europe, it's like really pessimistic, and many really smart people, hard workers, and ambitious people. They just leave. They go to Dubai, they go to Switzerland, to the US. So I think the economic activity and the momentum clearly is in emerging markets, and the world is heavily underweight emerging markets still.
Totally, 100%. Okay, Ronnie, we have really delved into some very structural, very macro mechanics, so we're going to lighten this up for a moment. Here it comes, Ronnie. I warned you about it. It's here. So this next segment is fun, okay? No Markets and Leaders podcast episode is ever complete without a fun little game. Okay? It's not serious policy advice. It's not controversial. It's purely humorous and playful. Okay? So, this game is called Central Banker Confessional. Here's how it works. I'm going to give you a fictional scenario. Imagine you are privately whispering and advising a central banker behind closed doors. No press conference, no public statement, just an honest, slightly mischievous, and various humorous conversations, okay? Your answers can be short, 1 or 2 sentences, very instinctive, no long explanations required. The wilder, the better, Ronnie. No wrong answers, and if you don't like a scenario, you can always say pass. Okay, you ready?
Mm-hmm.
Here we go. Inflation re-accelerates while unemployment rises at the same time. What do you secretly advise?
It's just transitory.
Tell me about that. 1 to 2 sentences.
It's just because of, I don't know, geopolitics or external reasons. Yeah.
Okay.
We don't have anything to do about that. It's just transitory and it's going to go away.
Pass it on.
Yeah.
Okay, next one. Good one. Bond markets revolt and yields spike up aggressively. What is the real move behind closed doors? What's your wild whisper?
Evil foreign speculators selling our bonds, probably the Chinese.
Send them out the door. Okay. The dollar starts sliding quickly while commodities surge. Do you defend it or let it weaken? What's the crazy advice?
Crazy advice. Let's just wait and call the White House.
Okay, call the White House.
Yeah.
Call the White House. They know what to do. Okay. Gold breaks to new highs while equities wobble. Do you talk it down publicly or do you stay silent?
Say that gold is just a tradition, and don't care about the price of gold. Yeah,
Okay.
it's just.
Thank you. Next.
Yeah.
A recession hits while debt levels are already extreme. What lever do you pull first? What's behind the scenes there?
Aggressively lower interest rates, obviously, like
Okay.
always.
Yeah.
And then say everything is contained.
Okay. These are good pieces of advice. I should be like writing this all down. I'm not sure that we're actually getting invited back to any central bank after this, but I mean, there's some great ideas here. So let's bring this back to the bigger picture then, okay? When you step back and connect all of this, you connect bonds no longer acting as insurance, gold still under-owned, commodities neglected, fiscal dominance rising, potential dollar weekends. What gives you confidence that this bull market is not finished quite yet?
Am I still talking to the central banker? No. This game is over. Because I would have told...
Okay, what would you tell the central banker?
I would say, quit your job, say it's for personal reasons or medical reasons, but just get out. You don't want to be blamed. And then, write a book.
Write a book.
And do like keynote speeches for 100,000 each year.
Best answer yet.
Yeah.
Now, what about for the investors watching? That's what you tell them?
For the investors watching,
Yeah.
just
Quit your jobs. Say it's for personal reasons. Then do keynote speakers for $100,000 each. Okay, seriously though, all things aside, what gives you the confidence that this is unfinished, this bull market?
well, just history and the just the facts, yeah. And I think we wrote like, I don't know, just the lasting gold trust report was 450 pages. Yeah, we wrote thousands of pages about gold and we really tried to understand the big picture. And the thing is, many people think I've got the most boring job because I think it's just writing about gold. Yeah, isn't that boring? And I say, no, it's like, gold is it's basically in the center. It doesn't change at all. Yeah, but what's changing is like everything around. Mm-hmm. It's about interest rates, inflation, geopolitics.
World economics.
Exactly. Yeah. So, and that makes it so fascinating, also so complex.
Yeah.
And And I think that, those things that we're talking and writing about for quite a while now, this is now really materializing. It took a little bit longer than expected, like usually, but I think it's playing out now. And last year's leitmotif was the big long, where we said, this stage of the bull market, now you will start seeing silver mining equities starting to outperform gold. This is happening. Commodities, not so much yet, but I think that's really next. So again, I think the risk-reward ratio in the commodity space is even better than in silver and especially in gold.
Right.
Can we be wrong? Absolutely. Yeah, of course. I mean, that's our job, to just question our exposure, our risk that we're having in our portfolios. But then actually, having a look at our funds, and I think that differentiates us from like people on YouTube just making forecasts, yeah, and those pundits, we've got daily net asset values, yeah. So I can make like crazy forecasts, but then actually, you will see how our fund performs, yeah, if our views are correct or not. So therefore, I always have the downside in mind. So very tight, risk budgets, hedging when it's advisable. So now at the moment, in one of our funds, we've got, I think, 32% cash. So we can allocate capital now that the sentiment has cooled off dramatically in the gold and silver space. But I think that's we won't get it right all the time. But I think on average, or let's put it that way, I think the scenarios that we saw coming, they're playing out pretty well at the moment.
Absolutely. So if we were to sit here and say 2030 and your thesis then plays out, what does the global financial system look like? 2030.
I think it's...
You have quit your job.
I think it's... I'm going to be even more baldy then. I think I'll still be fascinated by the topic of gold. We
100%.
will still talk about gold. We will still talk about commodities. So it's not a trend that will be, will just go away. Will the financial system look completely different? I don't think so, actually.
Right.
I used to say that, a couple of years ago, gold at 10,000, it's going to be riots on the street and, Mad Max scenarios. Now gold is trading at 5,000 and people still couldn't care less. And I think that we just get used to different price levels. It's like when I went to the Beaver Creek conference, the Precious Metal Summit, like 2 or 3 years ago, first time after COVID, I went to a restaurant and said, the steak is like $70. It's like crazy. 1 year after, I said, it's 75 now. Okay, so that's the price now. Now it's like 80 or 90 or whatever. Yeah.
Yeah.
So what I want to say is people just get used to higher prices.
Right.
Yeah, and now I think the round number in gold, like the 5,000 and the 100 in silver, that's like a psychological barrier for many. So now we're consolidating. We're like in the base camp for the, like if you're climbing the Mount Everest, there's like a couple of base camps. Yeah,
Absolutely.
and you just have to rest. Yeah, get used to higher levels. Yeah,
Altitude.
and then go up again.
Right.
Yeah. So in 2030, our official forecast for gold is $8,900.
Okay.
So we said that in 2020 already. We said our base case scenario is 4,800, and if inflation should be a concern in this decade, a decade that we called the golden decade already in 2020, then 8,900 is our target. So 8,900 from here until 2030, I think that's a CAGR of 12-13%.
Right.
I think that's possible.
It's doable.
The Dixie perhaps, so the dollar index at 75, 70. 10-year yields at, I don't know, 2% because there will be some sort of a yield curve control. Why not? Yeah. But I think it's, it's just going to be interesting the next couple of years.
So
And especially if you have this monetary view, if you've got this this view that most people don't have in financial markets. Yeah. I always say that compare it to a doctor, the patient is going there and saying, I've got a really bad cough. And the doctor, what will he actually do? Take some medicine like antibiotics and so on. But what if the patient is like a chain smoker for 40 years? Is that the right medication? And I think if you've got this holistic view that actually there's like fundamental flaws in our monetary system, and if you've got this monetary view that there's a remonetization of gold every couple of decades, like roughly every 40 years, then this is a completely different view on markets. Yeah. And I think that very, very few people outside of our industry actually have this view. I think there's more and more those closet gold bugs sitting in large institutions. They're kind of realizing now, but they're still sitting in large institutions. Yeah. Right. And it's, the larger they are, the more bureaucratic and the longer it takes for some change. So it's a process. Yeah. But I think this process now really has started.
Well, what a fascinating conversation. I'm sure, let's hold your book up. In Gold We Trust. This is phenomenal. This is the May one from last year. The new one comes out when?
20th of May, 2026.
20th of May. Make sure that you're going to grab your copy for sure. So great to have you here with us. Thank you again. And I cannot wait to have you back. As soon as this launches, I want the first copy.
Okay. All right. Thank you very much.
Thank you again.
Thank you, Lyndsay.
If the old playbook broke, then the opportunity is not just in owning hard assets, it's in recognizing regime change before consensus does. The 2026 In Gold We Trust report publishes May 20th. I encourage everyone watching out right now to go out and grab it as soon as you can and really give that a close look. So thank you again, Ronnie. And tell me, where can we actually find you? What's your website? Where can we find you?
ingoldwetrust.report.
Okay.
You can download all previous reports totally free of charge. You don't have to register or anything. It's free of charge. Yeah. Possible due to our premium partners that support our work. I want to emphasize it's actually 20 people working on the report. It's not just Ronnie.
That's right.
I'm just the ugly face of the In Gold We Trust report, but it's really a big team effort. So ingoldwetrust.report, our investment solutions, our funds, the webpage is incrementum.li.
Perfect.
And I'm also pretty active on Twitter, on X. So putting out some, charts, thoughts, random stuff about sports.
Who
music,
are you on
whatever.
X? Are you under Ronald?
Ron Stoeferle.
Okay, so try and say the last name. That is the real challenge here.
You did well.
Now, here's our fine print. These are the opinions of our own with possible vested interest in any or all of the companies that we speak about. Always be sure to speak with a licensed financial advisor and know your own risk tolerances. This is not to be used as financial advice. For a copy of our complete disclaimer, head over to appeton.com. I'm Lyndsay Malchuk. This has been the Markets and Leaders podcast. Remember, when the rules change, the winners are the ones who noticed first. So be sure to throw a like and subscribe to stay here and in the know. We'll see you next time.